Have you ever been running a successful online business, seeing those PayPal sales roll in and then suddenly hit a wall? Maybe you need to buy more inventory to meet demand, launch a new marketing campaign, or cover an unexpected expense, but your cash flow is tied up. Traditional bank loans can be a nightmare. Mountains of paperwork, long waiting periods, and strict credit checks that can feel like an impossible hurdle for a small business owner. It's a frustrating, all too common scenario. You have the sales, you have the customers, but getting the capital to grow feels like pulling teeth. It's a game changer for many online businesses, offering a unique financing solution that leverages your existing PayPal sales data to provide a quick cash injection. But how exactly does it work? Is it a loan, a cash advance, or something else entirely? What are the catches, the benefits, and the things you absolutely need to know before you consider it for your business? Today, we're diving deep into the world of PayPal working capital to demystify this popular funding option. We'll break down everything from eligibility and application to repayment and fees, giving you a comprehensive understanding of whether this financial tool is the right fit to fuel your business's next big leap. Let's start with a fundamental question. What is PayPal working capital? At its core, it's a type of merchant cash advance, specifically designed for businesses that process payments through PayPal. Unlike a traditional loan, it's not about an interest rate that accrues over time. Instead, it's a fixed fee that you agree to pay on top of the principal amount you borrow. This fixed fee is determined up front, so you know exactly what you'll pay back from day one. The brilliance of this model lies in its repayment structure. You repay a percentage of your future PayPal sales until the advance, plus the fixed fee, is fully paid off. This means that when your sales are strong, you pay more, and when sales are slower, your payments are smaller, aligning your repayment with your cash flow. A truly flexible approach for businesses with fluctuating income. Now, who is PayPal working capital designed for? It's primarily for businesses that have a solid track record of processing sales through a PayPal business or Premier account. This isn't a solution for brand new startups with no sales history. PayPal uses your past sales performance to assess your eligibility and determine the amount you can borrow. Generally, you need to have had a PayPal business account for a minimum of 3 months and have processed a certain volume of sales. For instance, in some regions, you might need to have processed at least $15,000 in PayPal sales annually if you have a business account, or $20,000 if you have a Premier account. These figures can vary, so it's always best to check PayPal's specific requirements. The key takeaway here is that your eligibility is based on your actual sales data, not your personal credit score. This is a huge advantage for many small business owners who might have a less than perfect credit history, but a strong and consistent sales performance through PayPal. So, you meet the eligibility criteria. What's the application process like? This is where PayPal working capital truly shines in terms of speed and simplicity. The entire process is almost entirely online and remarkably fast. You simply log into your PayPal business account, navigate to the working capital section, and you'll likely see an offer already pre-qualified based on your sales history. You then choose the amount you want to borrow up to your pre-qualified limit, which can be a percentage of your annual PayPal sales, often up to 35%, with limits sometimes ranging from $1,000 to $200,000 for first-time borrowers and up to $300,000 for repeat borrowers. Next, you select the repayment percentage, the portion of your future PayPal sales that will be automatically deducted. PayPal will then present you with the fixed fee associated with your chosen amount and repayment percentage. The higher the repayment percentage you choose, the lower the fixed fee might be, as it indicates a faster repayment. Once you agree to the terms, the funds are typically deposited into your PayPal account within minutes. Yes, minutes. This speed of access to capital is one of the most compelling reasons businesses turn to PayPal working capital. There are no lengthy applications, no extensive financial documents to submit, and no personal guarantees or collateral required. Let's delve deeper into the fixed fee and repayment mechanism. As mentioned, there's no interest rate. Instead, you pay a single fixed fee that is added to the principal amount you borrow. This fee is calculated based on factors like the loan amount, your PayPal sales history, and the repayment percentage you select. What if sales are slow? This is where the flexibility truly comes into play. On days when you have no PayPal sales, no repayment is deducted. This means your payments scale with your business's performance. However, it's crucial to understand that there is a minimum repayment requirement every 90 days. This minimum is typically a small percentage of your total advance. For instance, 5% or 10%, ensuring that even during prolonged periods of low sales, you are still making progress toward repayment. Most businesses with regular sales will find their automatic deductions easily cover this minimum. If you ever want to pay it off faster, or if you need to catch up to meet the minimum, you can also make manual payments from your PayPal balance or linked bank account without any early repayment penalties. This is another significant advantage. Unlike some traditional loans, you're not penalized for paying back your advance ahead of schedule. Now, let's talk about the pros and cons of PayPal working capital. Pros: speed and convenience. No credit check. Flexible repayment. Transparent fixed fee. No collateral or personal guarantee. Easy to reapply. Cons: tied to PayPal sales. Potentially more expensive than traditional loans. Limited loan amounts for first-time borrowers. Doesn't build business credit. Minimum repayment requirement. What about alternatives? If PayPal working capital doesn't quite fit your needs, there are other options to explore. Merchant cash advances from other processors like Square Capital or Stripe Capital operate on a similar model, leveraging your sales data from those platforms. Traditional small business loans from banks or credit unions offer lower interest rates, but come with stricter eligibility and a longer application process. Lines of credit provide revolving access to funds, and invoice factoring can help if you have outstanding invoices from business customers. Each of these has its own set of pros and cons, and the best choice depends heavily on your specific business needs, financial situation, and sales channels. In conclusion, PayPal Working Capital is a powerful and accessible tool for many online businesses. Its speed, simplicity, and flexible repayment structure make an attractive option for those looking to quickly inject capital into their operations based on their proven sales performance. Understanding how it works, from the fixed fee model to the sales-based repayment, is key to determining if it's the right financial partner for your business. It's not a silver bullet for every financial challenge, but for the right business, it can be a vital lifeline for growth and stability. With that said, thanks for watching, and until next time.